While you've been collecting a measly 1.24% dividend yield from U.S. stocks, Italy just handed investors a whopping 5.16%. And there's a $23.7 billion exodus happening right now as smart money flees American dividend funds. Most investors have absolutely no idea this is happening. But by the end of this video, you'll understand exactly why international dividend strategies just crushed U.S. funds by 180%. In the next 12 minutes, I'm going to reveal why international dividend ETFs returned an incredible 31.75%, while U.S. funds managed only 11.61%, and the three major risks that every expert warns about, but nobody talks about publicly. I've spent weeks analyzing over 50 financial studies, $163 billion in money flows, and performance data from the world's largest fund companies to bring you this research. You'll learn which countries are paying the highest dividends, why massive institutional money is rotating internationally, and most importantly, the hidden dangers that could either supercharge your returns or completely destroy your dividend strategy. The shocking discovery. Let me tell you about something that happened last year that completely changed how I think about dividend investing. I was reviewing my dividend portfolio, feeling pretty good about my 11% annual return from solid U.S. dividend ETFs like VYM and SCHD. Then I discovered something that absolutely shocked me. My colleague had been investing in international dividend funds, and his returns weren't just better, they were dramatically better. His iShares International Select Dividend ETF returned 31.75% over the same period, while my US-focused strategy crawled along at 11.61%. That's not a small difference. That's 180% better performance. I started digging deeper, and what I found was mind-blowing. The Vanguard High Dividend Yield ETF, one of the most popular U.S. dividend funds with over $50 billion in assets, returned just 11.61%. The Schwab U.S. Dividend Equity ETF managed 14.16%. Meanwhile, international dividend strategies were absolutely crushing it. The iShares International Dividend Growth ETF delivered 20.72% returns, and that's considered conservative compared to IDV's explosive 31.75%. But here's where it gets really interesting. This isn't just about one good year or lucky stock picks. There's something fundamental happening in global markets that most American investors are completely missing. The data shows that dividend stocks outside the U.S. have been thriving in environments where U.S. dividend stocks struggle to keep pace with technology-driven market leadership. Think about it. Technology represents 32% of U.S. equity market value, but only 16% of the U.S. High Dividend Yield Index. That's a massive performance drag when tech stocks are leading the market. But before you rush to dump all your U.S. dividend investments and go international, there's something Wall Street definitely doesn't want you to know. There are three critical risks that could turn those impressive 31.75% returns into devastating losses faster than you can say currency hedging. The hidden truth. The global yield revelation. Let's start with something that will probably blow your mind. When I mapped out global dividend yields by country, I couldn't believe what I was seeing. Italy leads the world at 5.16% average dividend yield. Australia comes in at 3.77%. The United Kingdom offers 3.62%. Even countries like Germany and Canada are paying 2.80% and 2.92% respectively. And the United States? We're sitting at a pathetic 1.24%, barely better than India's 1.25%. The average yield on the S&P 500, what most Americans get, is just 1.24%. Yes, if you buy only the highest yielding U.S. stocks or special ETFs, you can get more, but so can you in other countries. For comparing entire markets, it's the averages that matter most for big picture strategy. This isn't just about individual companies being generous with dividends. There are structural reasons why international markets offer higher yields. Australian companies benefit from a unique dividend imputation system and have traditionally maintained higher payout ratios. The ASX 200 index is heavily weighted toward dividend-rich financial services and materials sectors. European markets have particularly benefited from rising interest rates, with financial services emerging as the best-performing sector over the past 3 years as higher rates increased net interest margins for banks. Here's a perfect example of this yield differential in action. The Vanguard International High Dividend Yield Index ETF currently offers a 4.45% yield, nearly doubling the 2.86% yield of its U.S. counterpart. The Schwab International Dividend Equity ETF provides a compelling 4.17% yield while maintaining rigorous quality standards through its focus on profitable, stable dividend-paying companies. But this massive yield advantage isn't just theoretical, it's driving real money. And that brings us to the second revelation that's reshaping the entire dividend investing landscape. The money flow secret. Remember that $23.7 billion figure I mentioned at the beginning? That's not just a random number. It represents the largest flow of capital into global dividend-focused ETFs in 3 years, and it all happened in just the first half of 2025. This surge reflects a massive investor rotation toward income-generating assets amid geopolitical tensions and economic uncertainty that most retail investors don't even realize is happening. European ETF markets have seen particularly strong momentum, with dividend strategies collecting $163 billion in year-to-date inflows compared to $115 billion at the same point in 2024. That's a 42% increase in institutional money flowing toward international dividend strategies. When you see this kind of money movement, you know something big is happening. The money flow patterns reveal exactly where the smart money is going. Energy is leading global dividend yields at 4.75%, followed by real estate at 3.7%, utilities at 3.3%, and financials at 3.0%. By region, Europe commands the highest dividend yield at 3%, while Asia-Pacific delivers 2.6%, substantially exceeding the U.S. average of 1.4%. Major technology companies are even getting in on the action. Meta, Alphabet, and Salesforce all initiated dividend payments in 2024, marking a fundamental shift in how growth companies approach shareholder returns. This convergence of traditional dividend sectors with technology giants is creating opportunities that simply don't exist in U.S.-only strategies. The institutional investors driving these flows aren't just chasing yield, they're positioning for a changing global economic environment where central banks signal potential rate cuts throughout 2025. Higher-yielding international assets become even more attractive when rate cut expectations reduce the appeal of risk-free treasury returns. But here's what absolutely nobody is talking about publicly, and this is where things get dangerous for unprepared investors. The currency trap. This single factor could completely erase all those impressive gains I've been showing you, and most investors don't even think about it until it's too late. Currency fluctuations represent the most significant risk factor for international dividend investing, potentially eroding returns, regardless of how well the underlying assets perform. Let me give you a real example of how devastating this can be. A strengthening US dollar can substantially impact returns when they're converted back to dollars. During periods of dollar strength, international returns have significantly underperformed despite positive local market performance. We're talking about a 10% dollar strengthening potentially reducing your international returns by 8% to 15% depending on your regional exposure. The impact varies dramatically by region. Emerging market currencies typically exhibit much higher volatility against the dollar, potentially creating massive swings in your total returns. European currencies generally show more stability but can still generate meaningful impacts during periods of monetary policy divergence between the Federal Reserve and European Central Bank. Here's a specific example that demonstrates the scale of this risk. The Australian dollar has historically averaged around 0.7517 Australian dollars per US dollar since 1983, but we've seen significant deviations that create both opportunities and devastating risks for investors. When the Aussie dollar strengthens against the US dollar, your returns get amplified. When it weakens, even strong local performance can turn into losses when converted back to dollars. Currency-hedged ETF options exist to help mitigate this risk, but they come with additional costs and complexity. The Schwab International Dividend Equity ETF and similar funds offer both hedged and unhedged versions, allowing you to choose your preferred exposure level. However, hedging eliminates potential currency gains during periods of dollar weakness, creating a fundamental trade-off between stability and upside potential. Most investors who get excited about 31.75% international returns don't realize that currency movements could turn those gains into losses overnight. But that's not even the worst part. There are respected financial experts who argue that international dividend investing is fundamentally flawed, and their arguments might completely change how you think about this strategy. The contrarian warning. Now here's where things get really controversial, and I need to share some perspectives that might completely flip your thinking about international dividend investing. Some of the smartest people in finance are warning that global dividend strategies could be a costly mistake, and their arguments are backed by serious academic research. Kent Demian from Johnson Financial Group warns that global dividend strategies can significantly narrow your investment opportunities and undermine portfolio diversification by focusing exclusively on dividend-paying companies. Think about this for a moment. When you commit to dividend-focused investing, you're automatically excluding a huge portion of potential opportunities. Analysis of Vanguard sector ETFs reveals that only 63% of U.S. stocks paid dividends in 2023. Meaning dividend-focused strategies automatically exclude 37% of potential opportunities. Internationally, this problem gets even worse. Dividend strategies often overweight particular regions and sectors in ways that create dangerous concentrations. Australian companies receive disproportionate weightings due to high dividend policies, while Japanese companies, representing a significant portion of international markets, receive minimal representation due to historically low dividend payments. Morningstar research demonstrates that dividend strategies suffer from sector concentration risk, where traditional high-yield sectors like utilities and financials dominate portfolios at the expense of growth sectors like technology and healthcare. But wait, it gets worse. There's compelling academic research suggesting that dividend-focused investing might actually harm your returns due to tax inefficiency. Research from multiple academic sources highlights that dividend investors face double taxation, where corporations pay tax on profits used for dividends, and investors pay additional taxes upon receiving distributions. International dividend investments compound this problem through foreign tax withholding requirements. Funds must pay taxes on capital gains in countries where they invest. And while investors may receive foreign tax credits, these credits often don't fully offset the tax burden. This becomes particularly problematic for investors in tax-advantaged accounts, where the credits provide no benefit. Professor Aswath Damodaran's research suggests dividends may actually harm investors due to tax disadvantages compared to capital gains, which can be deferred until sale. Here's perhaps the most damning criticism of all. University of Technology Sydney research reveals that individual investors do not improve their portfolio performance using ETFs, mainly due to buying at the wrong time, not choosing the wrong ETFs. This timing problem becomes significantly more acute with international dividend strategies due to currency and sector rotation complexities. The study found that investors consistently underperform their chosen ETFs by making poor timing decisions, with potential losses of 2% to 3% annually from mistimed entry and exit points. Samuel Hartzmark and David Solomon's research introduces what they call the free dividends fallacy, demonstrating that investors treat dividends as separate from total returns, leading to systematic overpaying for dividend cash flows by 2% to 4% annually. This behavioral bias becomes more pronounced with international strategies where higher yields may mask underlying valuation concerns or currency-adjusted performance shortfalls. So where does this leave us? Are international dividend strategies a golden opportunity or a dangerous trap? The truth, as usual, lies somewhere in between, and the answer depends entirely on how you approach the risks I've outlined. Resolution and balanced approach. After diving deep into both the opportunities and the warnings, here's my honest assessment. International dividend ETFs offer compelling opportunities. The 31.75% returns and 5.16% yields are real, and the money flow data suggests institutional investors see genuine value in these strategies. However, currency risk, tax complexity, and concentration concerns require careful planning and risk management. If you're considering international dividend investing, you need to approach it strategically. First, understand your currency exposure and consider whether hedged or unhedged funds align with your risk tolerance. Second, treat international dividend investments as part of a broader diversified portfolio, not as a complete replacement for domestic strategies. Third, be aware of the tax implications and consider holding these investments in appropriate account types. The sector concentration risk is real, but it can be managed through thoughtful allocation across multiple regions and investment styles. The 37% of non-dividend paying stocks that you'd miss by focusing solely on dividend strategies might include some of the best growth opportunities, so balance dividend income with growth exposure. Most importantly, remember that those impressive 31.75% returns represent a specific time period and market environment. Past performance never guarantees future results, especially when currency movements and global economic cycles can dramatically impact returns. The bottom line is this: international dividend ETFs have delivered impressive returns with yields that make U.S. alternatives look anemic, and massive institutional money flows suggest this trend has momentum. But currency risk, tax complications, and portfolio concentration concerns mean this strategy isn't suitable for everyone and certainly shouldn't represent your entire investment approach. The key is education, diversification, and understanding exactly what you're buying before you commit your money. What do you think? Are you ready to go global with your dividend strategy, or do the risks outweigh the opportunities? Let me know in the comments below. I read every single one and often create follow-up videos based on your questions. And if this analysis helped you understand international dividend investing better, smash that subscribe button and hit the notification bell. I publish new market research and investment strategy videos every week, and you won't want to miss what's coming next. This video is for educational and informational purposes only. Investment performance shown is based on historical data and projections. Past performance doesn't guarantee future results. Always conduct your own research and consult with a qualified financial advisor before making any investment decisions. Thanks for watching.